Welcome to the Exit Ready podcast. Ryan Ray here as always. Today you're going to love the episode. Be sure to never miss what's going on with the Exit Ready cohort intensive by going to www.rgahub.com/exitready. That's rgahub.com/exitready. I'll put a link to this in the description below so you can check it out. But if you're an owner, you're not going to want to miss this. Now, let's get to the show. Well, Jackie, as we were saying before we hit record here, we've heard each other's names. I think Clint Fiore says you're the best business broker in the United States. He's told me that a few times, I think now. But we never met, so it's nice to finally meet you.
Yes, it is great to finally meet. We connect, we comment on each other's posts. I do know that, and we have a lot of mutual friends. So, and we've been in the same place multiple times, I believe.
Yeah,
so I was looking. Yeah, conferences, but
yeah, I think we've been. Yeah, we have. We just never have crossed paths. So it's nice to finally meet you.
Yeah.
So for those of the audience who doesn't know who you are, maybe give a quick background.
Sure. My name is Jackie Hirsch, and I've been selling companies since 1998. And, it's been a long ride. And sometimes people are like, wow, you're really blowing up. I'm like, oh, yeah, 27 years of like overnight success. But it's been, a good ride, selling hundreds of companies. I'm a generalist, so all different types, everything you could imagine, and even ones that you can't. And I think probably the most fun thing that I do is that when I sell the business, I make somebody wealthy. And when somebody buys the business, I also make somebody wealthy. And that is just really an exciting piece of what I do. And I think that makes the most difference in people's lives.
Yeah, and I think that's one of the reasons I wanted to get you on was because you talk about making wealthy. And M&A is, I call it a high stakes game because it is a lot of money changing hands for most deals, right? There are those crazy things that happen, but most deals, it's a lot of money changing hands. And I don't know, you're the expert here. I think that a lot of owners, at least in the size deals that we work in, so not like the Exxon Mobils of the world, but the size deals that we're working on, they don't realize how much money is on the table for them. And they wait too long to try to build out to capitalize it. That's what I've seen, but you've been doing this for longer than me, so tell me, am I crazy?
You're dealing with personal handmade money. So it's emotional, it's real, it's tangible. People are nervous. Do you sometimes feel way too long? Yeah, because it's hard it's really impossible to time it exactly perfect. If you do hit good timing, it's a lot of times luck. But they're not really sure what to do, and they've never done it before, and they might not do it again. So there's no, and the people who get good at buying companies, they work at it for years, and they study it for years. So it's hard for a seller to just get it right the first time and get everything right in the deal, and it's very stressful. I try and take away a lot of that stress and mitigate that with some of the knowledge and tips and tricks, which I'll share today, about how to plan better. But it's still really tough and it's still really stressful.
Yeah, I think that, so the first time, I've told this story before, but the first time I ever heard the term EBITDA was worked for my dad's company, and I won't get into the oil and gas specifics of it, could bore you, but the Haynesville Shale had blown up anyways, so we were really growing. And our competitor, or I say competitor, one of the bigger companies in the space was there, and they're looking to go public. And so they're trying to buy up companies. And they're like, hey, what's your guys' EBITDA? We're thinking about buying you out. We're like, EBITDA? Yeah, we never even heard of that term. Didn't even know what that meant. We called the CPA, get in the truck. We're like, hey, what's our EBITDA? We don't know. And so to your point about sophistication, they ended up not going public, but they were more sophisticated because they understood just the terms and stuff like that. And I've tried to encourage people to talk redneck to redneck. First, I'm a redneck, so that's just kind of my thing. But I've seen a lot of people in the space, M&A advisors or brokers. I thought EBITDA, adjusted EBITDA, and all this stuff's like owners care about a lot of things. EBITDA is not one of them, but maybe, or SDE even, maybe they should though. So I haven't seen a lot that have cared about those kind of things, or if they have, I've seen the few that have tried to track it be wrong, like they've miscalculated a lot. So should they care about those fancy M&A terms, or is that something that this kind of in the space that people should care about?
No, they should 100% care about those terms. And they do need to understand target and mandate and roll up, and here's your piece of the equity, and if their equity is going to be in a new company or in the current company or in a holdco, or does it join with other companies. I mean, there is a lot to understand. And are they going to mitigate some of their taxes through some different scenarios? There should be some planning involved. There should be some discussions ahead of time. Problem is, a lot of sellers are so in their business that they don't have time to work on the business. They don't have time to work on the sale. And even if you hire a professional, it still takes up a lot of your time with the sale. And not just a lot of time physically, but I think it takes a lot of time in your head because it's very stressful the whole time with all the things that have to get done. And that's something, again, we'll try and mitigate. And I have a list of, I tried to like pull out some of the best stuff ahead of time for you, that we can share for how people can better plan for their sale and what they can do to mitigate some of the risk for the buyer. Because the whole thing that the buyer is trying to do is de-risk the investment. The better that they can de-risk the investment, the more money you'll get for that business.
Yeah, no, you said it well there, because it's sellers will get offended by the buyer asking questions, and it's like, well, you're asking for millions of dollars, like you're asking for a lot of money.
Right.
Wouldn't you ask those
Right.
same questions? Like, what are you offended
But
about?
there's a way to ask them. I mean, there is a
Yes,
way to
that's
ask
true.
them,
Yes.
and I think that, the delivery is important, and how you ask them. I had this one, guy from Stanford come and meet with a commercial glass company, and it was an awesome company. And this guy was so condescending and like, just, I mean, it was super unpleasant. It was a very unpleasant meeting. Of course, the guy from Stanford thought it went tremendously well and that the sellers loved him and they hated him, said that they never wanted to see him again or hear his name. So it was very interesting. I think that some people are better at it than others, and I think some of the private equity guys get very good at it. And there's ones that go out and meet with the sellers that maybe have like a military background, or they, had a working class background and then like went up through the ranks with MBA and then investment banking and then private equity, some of those things, or worked at Bain or some of these different backgrounds. So they can kind of like walk the line between, the trades and private equity. And I think that that's an important mix as well. So it's just, and sellers are worried because they feel like they're missing something. And so I created a list of some of the items so that they don't feel like they're missing as much and they can at least do a better job preparing on the front end.
Yeah.
And then, of course, Ryan, you'll handle the rest with all of your exit planning.
Well, I won't handle the rest. You're the best. You're the best, according to Clint. So we're keeping that moniker. So I want to touch on timing real quick, because I think that's important. And
Sure.
you said you had some points you want to go through. So let's hear those. Timing, I think, I've talked to owners before, and they're like, well, we want to wait until the election, or we want to wait until this happens, or wait. And it's not like
Yeah.
the tariff news this year, which kind of came up out of nowhere, like, oh, this is going to happen. This is kind of like, oh, these events we're waiting for. And first off, maybe unpack how long an M&A deal actually takes to get done, so people understand when we say timing, how long it is, and then maybe some weird stories of things that you've seen. Because I know a big company, before I was even in the space, they went to market January, February 2020, and didn't sell because they couldn't, and
Right.
they weren't waiting on time. That was just their plan. Like, we're going to market here. And then they didn't sell until 23, or I think 23, because they went back to market in 21 or 22, and it was like, no, the valuation isn't there. And so talk about maybe
Yeah.
timing, and then, how does that play into people's perspective? Because again, it does seem like a lot of people wait until it's right there at the end. It's like, oh no, don't wait that long.
Yeah. Timing can, there's a few factors of timing. The amount of time it takes to prepare the deal, to put the deal on the market, and then to transition the deal, and then whether or not you'll stay on. So actually, this could be a multi-year process. But let's say you spend 3 months getting the business ready and getting the sim ready, cleaning up your business, and you have good books. Let's just say you spend a couple months doing that. I always tell people to plan. That might take a year. You might have some failed deals or broken deals that happens. I would say a lot of deals can get done within 7 months. There's a deal that I'm supposed to close tomorrow and that we put on in February. So, that's what, 10 months. We had a broken deal in that time frame. So that happens. And there's another deal I put on the market in August, and that's going to close the end of the month. It's a little bit on the faster side. No banks involved. It's private equity. So, it could be a variety of things. And then that seller is going to stay on for 2 years. And then the seller for tomorrow is staying on for like a few weeks. They're completely out of the business, have full management in place. They only go there once a week anyway. They really have all of their things delegated. People have access to buy things and order things and manage things, and they just are very hands off. They're, in my opinion, a master at delegation. Incredible, really a master. So, I would always plan for a year. It's going to take a year. And there are certain times to put a business on the market that are better than others. I don't particularly think like right before Christmas is a great time. First of all, like no one really feels like working. You will get people who have free time that will take up all the time that you'll let them, right? Because they don't have anything to do. But you have to think about if you want to do that. And then if the seller wants to do that. So January, you'll see a lot of stuff come on the market. And then financials won't be ready until like mid-March, if you're lucky, to get the tax returns. That's on the early side. So, that's a good time. You'll see a lot of stuff come on first quarter. You'll see a lot of stuff come on third quarter. And then you'll always see deals come on the market sprinkled throughout the year.
Yeah. So if you're thinking I'm going to sell, it's not 30 days, it's a year, right? And so, it can be shorter, I think you said 4 or 5 months for that one deal, but 7 to 10 months. And so a lot can change. And so that's why it's like, okay, if you wait until you get burnt out and then you got a year, you're burnt out and then you got a year to get it off your plate.
It makes it unpleasant.
Right. Okay. So what are some things that you've seen that owners could fix, but they don't, or however you want to phrase it, that hurts their value?
Okay, well, let's talk about some things they can do on the front end. First, everybody says, clean up your books, but how do you do that? If you don't really know if your accounting's not good. I would say the first step would be to get a sell side quality of earnings. And yes, it is thousands of dollars and it's worth it. And that will help you understand how your business works. It'll help you understand how a buyer is going to look at your business. It'll help you understand your seasonality better and how you normalize numbers. Like I have a seller and he pays his rent all in the month of October, like the whole thing, because he owns the building. And so he just always pays in October. And I said, okay, could you have your accountant redo that? And this year you pay it, monthly so that it's normalized. And he said, sure. So we fixed that ahead of time, right? He used to also pay his whole salary in December. And again, the QofE would normalize something like that so that a buyer can see, so it doesn't have these wild fluctuations. And that's what you're trying to see. You're trying to get the numbers on an accrual basis. You're trying to match up projects to when the income arrives and when you get the job and when you get paid and where the inventory is and labor that goes with it. You're trying to match up all those things. So a sell-side QofE would be huge. And then, cleaning up the books. If you're paying your kids and your mother-in-law and they don't work there, then try and make it so that's in one column. So it's easy for people to add back instead of, scattered about, or sometimes in wages, sometimes in contractor. Like be very specific so the add backs would be easier. Some of those financial things. And then, like we did this one deal where it was, and I own this company with my brother. And so this was my brother's deal, but the seller built out a boathouse for $250,000 and hid it all in the cost of goods of a construction company. So we couldn't really add that back. And $250,000 is some real money, especially on a 4X. You're missing $1 million. And was it worth the tax savings for $250,000? I can guarantee you it was not. So it's stuff like that you really need to work on ahead of time. But at a minimum, the year you want to put out on the market, at least be super clean that year. So that would be my first thing as far as keeping the numbers.
Yeah. Hey, quick break there. I want to tell you about the Exit Ready Intensive. It is a cohort-style learning for business owners who really want to maximize their value, and the speakers we have lined up are truly incredible. It's 10 weeks, starts on January 13th, and you can find out everything you need to know by clicking on the link below the video, or if it's a podcast, in the podcast notes, or going to rjhub.com exit ready, and you can sign up for the email list there. But this is going to be your chance to figure out how to not leave millions of dollars on the table and maximize your company for exit, whether you want to exit today, next year, or 5 years from now. Now, back to the show. So QofE, I'm trying to figure out a way to make an analogy, because I want to say it's like an appraisal, but it's not really an appraisal, because an appraisal might generate some other emotions. So what's a good way to say, like, if you don't know what a QofE is, here's what it actually is?
Like a proctology exam? Like, would that be better than the appraisal? Okay, all right. So maybe not. Let me think.
Okay. Okay. I'm trying to encourage people to get one done.
So I would say it's more like a financial inspection. So that also doesn't sound good. I think appraisal even sounds better, but appraisal is not accurate. It would be more like a financial. I didn't really come to the meeting with this in mind. You're trying to normalize the earnings and see what it would look like if the business were run in a true accrual basis. So you're trying to get it as systemized as possible. And really, it's just an organization. So maybe we could look at it as it's a financial organization for how the business would be run if everything were normalized. And maybe that sounds like better than a proctology exam.
No, well,
but it's going to feel like that. It's going to be unpleasant. And all you can do is just smile and say, look, a lot of people do it and it's not that bad.
That's such a great way to put it, but I got to figure out a way that people will go, I need this, because you call it that.
They do.
But the buyer's going to make you get one. And that's the thing. Yes. Like, the buyer's going to make you get one. And so that's, and then if you don't have one, you got to argue against theirs. And it's like, oh, you're fighting uphill. And so at least having one will give you some playing ground.
All right. Well, what if, right? You sell this vision, right? When I sell a company, my goal, and I don't always achieve it, but my goal is like the buyer and the seller are like holding hands, skipping to the campfire, singing Kumbaya. I know it seems unrealistic, but that is my vision. And a lot of times I make it happen. Not literally, but like a lot of times, like the buyer and seller have a great relationship. And I feel like I knit that together because it's so important. And so I think, when you do this, like you hand this report to the buyer and say, here's my financial health. And it's like in really good shape. And then you can get your buy side QofE, and I have everything ready. So you're welcome to talk to my QofE provider and it'll be so much faster for you. Like you're really setting them up for success when you do that. And you're setting yourself up for success because you're getting everything organized and prepared. And there's a lot to be said for that. Whenever it's why you should arrive early to a meeting so that you arrive, you're relaxed, right? Nobody wants to run in and be like, sorry, I'm so sorry I'm late. There was a blah, 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 blah. No. Arrive on time. There should be zero excuse unless there was like a death. Okay, like zero excuse.
Yeah. Okay, so Proctology exam was the first thing you recommended they get done. What else should they get done that's maybe more pleasant?
All right. So, another thing is like people always talk about low-hanging fruit and mid-hanging fruit and all of that stuff. So like low-hanging fruit, clean up physically the location. Now, one of my sellers was like, if it's too clean, my employees will notice something. Okay. I agree with that, right? Employees aren't stupid. If all of a sudden you're like cleaning and you're like dusting like fake plants or like redecorating and you look all busy all of a sudden and it's not Christmas or some other time of year to do that, like it's not normal. So in that scenario, I think at a team meeting, say, we've been in this space for 10 years or 20 years. And I'm thinking like, we really probably should like clean it up a little bit. And I'm thinking about getting some new furniture, maybe some new art, or maybe painting, and I'd love your feedback. So here's what I'm thinking about doing. And then you can write out what you're thinking about doing, and then you can ask your team's feedback and say, I'd like to try and do this in the next 3 to 6 months. So we'll just work on it a little at a time because I don't really enjoy any of this. Then it won't be suspicious, right? Again, you're planning, you're putting it out there. And that way you are free to get rid of stuff and say, I'm going to meet with Bob over here and we're going to walk around the yard and see what we can throw out. And then Bob and Jim, they're going to be tasked with getting that done. Right? I mean, make a plan and say, my goal in this is to be maybe more efficient because it looks better. And
Yeah.
maybe that doesn't work at all, but we'll try it because it seems like low hanging fruit for us.
Okay.
Right? Mid hanging fruit, of course, is like, yeah, go ahead.
No. I have a contrarian take there. I'm curious. I don't cut you
Yeah.
off, but you've invoked something. Made me think. So I have a contrarian. I think it's contrarian view is that, hey, quick break here. If you're an owner, do you know that most companies will never actually sell? That means that all those years that you put into building your business are for nothing. If you want to build a business that's valuable, that people will want to buy, and you can make potentially millions of dollars from, go to rjhub.com or click in the link below. That's rjhub.com or click on the link below. And now back to the episode. Owners should tell their employees much earlier about their desire or plan to exit and should tie it to two bonuses. Their annual bonus that's tied to revenue, margin, stuff like that, and then a second bonus which is tied to exit, which means, hey, we're going to go exit now. It might take a year, but just so you know. And then when we do exit, you know how this works for you, because if we get this much, you get this much. And so that conversation, a lot of owners I've seen, they try to wait to the very end, and it's like, surprise, well, the only person that's happy is the owner, you know, and the buyer, of course. But by telling your employees earlier, because your employees, at some point, they're going to leave or die, right? They're going to leave or die. That's their two options. And so they're going to leave or die.
Yeah.
Or you shut down. And so they have their own thoughts of what's going to happen. So if you're telling them, hey, here's your bonus structure for if we sell or not, but if we do sell, this is what we get, then they're incentivized to help you get more. And so they make more money, you make more money, and then if you need to earn out, they're incentivized to help you get that, because they're going to stay on the business. So that's contrarian, I think.
Right.
But you tell me if I'm crazy, or what are your thoughts on that?
Well, I guess have you put that into practice, like personally before, with a company that you've owned and sold?
No, the company that I sold, no. But so that was a part of the problem, was that before I bought it, it was a family-owned business, but I never knew what my dad's plans were. I never knew, right? And so he would kind of say, well, this, you can get this, kind of vague, abstract stuff. And that's where we're going, it would be nice to kind of know what was gonna happen. And so then
Right.
you'd have some key employees. It's like, well, and his bonus structure, I don't want to just hate on him much, but the bonus structure was like every year, like, oh, this is what you get. Like, oh, how do we come up with that number? I don't even know. Like, I don't know how we got that number.
Oh, yeah.
And so it's like, and then when you go to exit, it's when I bought the company, it's like, okay, this is what I'm buying it for. And then when I go to sell the company, it's like, well, I only had it for 2 years before I exited. So I didn't put this in place, but I've just seen so many people, they're so afraid to tell people. And I get it. If you haven't told anyone what your plans are, then I get it. But if you tell them today and you don't plan, you don't want to sell for 5 years or 10 years from now, then you're at least being open and honest about it. And it becomes normal, right? It just becomes normal. And so I think, especially if you're an owner, like if you're in your 70s, they are sitting around wondering what you're going to do. Like they are sitting around wondering at some point what you're going to do. And so telling them this is your plan, I think, is quite helpful. So, but I don't know. It's contrarian. So you tell me.
Okay, so last year I sold a business for somebody who was 81. So, it doesn't always, just because you're like 65 doesn't mean like, the door's like hitting you on the way out, right? Like there's time, right? And so some people want to work longer than others. And then there was another business I sold last year, and he was 65, but his wife was 75, which I always thought was interesting. And so he wanted to retire because she wanted to travel. And she's like, listen, like, like, when are we going to do this? So there's all sorts of different times. And sometimes you tell the key people and sometimes you don't. However, when you tell some of the workers who really don't understand this process, it immediately goes to fear, like fear of livelihood, fear of job security, fear of a timeline. It's unknown. Like, I might sell someday. So that means they're thinking about selling. Well, then maybe I should just find another job now. Right. So there's some things that go in place. And I think the team feels a lack of security a lot of times. Now, there are different, sellers do different things. And we had a seller that bonused everybody from like the receptionist all the way to the main team at closing, like in Taylor Swift fashion, which I totally respect. We have people that do it, where just the key people get a bonus. There are ways to mitigate some of it, but I think the biggest risk is on the seller. And they're the one that takes all the risk every day, not the employees. So it's really up to them. They're the ones taking the risk. Do they share it with the employees? Do they share the vision? Do the employees agree with it? And the seller has to be in the mindset to mitigate all of those questions and handle all of that feedback. And they're not always sure if they can. This is an emotional journey a lot of times, even for, a company that I'm selling now for, they do about 50 million in sales, and it's an emotional journey for them. This is a big business with, well over 100 people. So I do agree that it's a contrarian belief that you should tell everybody before closing. I think you should prepare and maybe share with your key people if you feel that that's necessary, and if you need the key people to stay on, and have a bonus structure for them.
Yeah.
But I don't
Let me
know if I would share it top down.
Okay, let me clarify, because you made some good points here. When I say everybody, I mean you should have 2 bonus structures, and that could be, for everyone in the company, or however you're doing your bonuses. That's tied to your annual revenue and stuff like that. And then you should have a bonus plan for exits, because you might be tied to it. You might need an earn out. There's stuff like this. Whoever is in that second pool, that should be aware that this is the numbers we're trying to get to. If you get this QofE that you mentioned, hey, we got a QofE, we're valued at 10. If we get to 13 million, here's what we got to do. We can get there in 3 years. You guys get this. Now they know that this is, I don't know in 3 years if I want to sell or not, but just so you guys know. So maybe not to clarify. Yeah. It wouldn't be that everyone in the company has to know that you might sell in 3 years, but the people who will be rewarded for that, they should know, because we talk about attracting top talent and keeping top talent. Well, if you're saying, hey, if you help me get to 13 million, I'm going to pay you whatever it is, right, then top talent likes that.
Correct. But sharing with your key team is different than sharing from top to bottom. Those are not the same set of people.
I'm glad you clarified when you push back, because
I do agree with that. But like, if you're sharing with a person who like is doing kind of like paper shuffling and making 80 grand a year, I think that person's going to feel stressed. Yeah. I'm not talking about your key management or salespeople. Okay. Hey, if you hit this target, you're going to get more bonuses. I think they'd be game. Like, the people who know how to work and make big dollars usually like more big dollars. So right. I don't know if I would always do it, but I agree with that more. But, sometimes people tell everybody, and it causes a lot of instability and insecurity for the team.
Yeah. So if you're going to tell everyone, what I would say is you can't tell them all at once. You'd have to tell the key managers for like a year or two, this is just the numbers, this is where we're at, this is where we're trying to go, here's our structure, so that it becomes part of their culture. And then when you tell the broader culture, like, hey, if we ever get to 15 million in valuation, we're going to sell, but here's what that, so that everyone would be further down the road. But the key staff, that's a key, whoever you're going to reward, because if you do reward people for your exit, they think like an owner. You got to give them equity, just a bonus. Right. They think like an owner now. They're going to make a lot of money when you make a lot of money. And you're right, the risk is on the owner, but they can help you de-risk it as much as possible.
Mm-hmm. And if you tell everybody, don't do it on a Friday, like, do it on a Monday with a lot of food.
Well, you do it on Monday. Yeah. Well, but you mentioned like the Proctology Exam for the QofE, and there's certain things that you're going to have to do that won't be, like if you have customer concentration issues, and you've got 5 great customers, but you need to get 10 more to really diversify. Yeah, your sales guy's good with customer A, because he works and plays golf and does all this stuff, but if he now understands, these new 10 is going to help me make X amount of dollars, that's why I'm doing it, because that's how you're thinking as the owner. Like, I'm going to make millions more, whatever it might be, by spreading out our risk. And so if the salesperson understands the boss isn't being a jerk, he's putting money in my pocket when I do this, then he buys it. So I do think it helps with that higher level buy-in of why you're wanting to move these around, because these things are not easy to do for some companies.
Agreed. But not all your staff is going to think like an owner.
Yeah. Yeah. Yes. So yes. So I think we sort of agree that you can't tell everyone day one. I want to be clear on that. You do need to have a bonus structure that's tied to the key staff, whoever that is. That can depend on, $50 million companies can be different than a $3 million company. So whoever that is.
Correct.
And I do think, and this would be a theory, so this is to your point. If you went along 3-5 years and the key staff kind of understood, the numbers they're trying to hit, and they began to hit them, I think it's possible. I mean, if you're on a team, and maybe this is where I'm crazy. If you're on a team, the goal is to win the Super Bowl. That's the goal, or to win the championship, or whatever it is. The goal. And to your point, there's lower level employees that don't understand M&A. Heck, most owners that I've talked to, they don't even understand EBITDA. It's like, and it's not being disparaging. I always say this: it's not being disparaging. It's just not the world they live in. So I get it.
Right.
But if you make it part of just what you talk about openly, then like, hey, our goal is to get to this, then I don't know. If you said like our goal is to get this, but it's like 5 years out.
I do know people who do that. I do know people who do that. And some people are more open, and they have a very organized, regimented kind of EOS system, and that works. And I think that could be great. So I think that there's some pluses and minuses to that that are fantastic. But again, I'm not sure if it's right for every company, and I don't know if it's right for every seller. And not every seller is like a charismatic, visionary that, gives great meetings. Some of them are just great at what they do. Yeah. Well, it's true. Like some of them are great at what they do and super high integrity. And the way that they've gotten where they've gotten is because they show up, they're diligent, they're honest, and they work really hard, and they get the job done, and their clients and employees know they can depend on them. But it doesn't mean that they're like a world-class speaker and delivering of some sort of system and plan of action.
Yeah. Well, okay. Final thing I would say is, don't go in Monday morning and say, hey, this is the plan. Like, you need to put some thought into this. Get your valuation, understand the bonuses. You need to think through all of that before you ever broach it. This is not a willy-dilly, just like, hey, so you need to be very thoughtful on how you do this. And to your point, the one thing I hate about most advice is like, everyone has to do it this way. You're right. Not everyone has the personality for that or the skill set. So that is something to consider. I would say, whether or not you tell your employees, though, tie your key management staff to a bonus, to an exit, even if they don't know about it, because you might need to earn out and you want them to stay. So I would say that, even if you don't tell them, right?
Yeah, I think that's a great plan, and I think that works. But then, like one of my sellers is worried that what they're giving isn't enough, or they feel it's enough, but they're worried that the person won't think it's enough because no number would be enough. Right. And so, there's all sorts of different risks when you do this, and it's hard. Yeah. And I think that's why, I feel for sellers when they're selling, and I feel for buyers buying. Like it's a hard go. It's doable, but it's a lot of work, and the reward is there, but it's like when you build a house and you're like, God, why did we put that there? When you see it in person, right? Yeah. Like, what I'm talking about? Like, I'm like, why did we make that decision? I look at my shower sometimes, I'm like, what were we thinking? And what was everybody else thinking? Nobody commented. So it's the same. Like, you'll never get every piece of the deal right, even for people who do it all the time. It's kind of like, I'm sure Serena Williams looks at some of her games. She's like, why did I hit that ball? She is like one of the best people in the world, right? And she's like, oh, I could have just done a little bit more spin. And, or Taylor Swift, like, I think her show is amazing, but like, maybe she's like, oh, I didn't really hit the note exactly how I didn't notice, but like, she might notice. Sure. Right. Or Jalen Hurts in the tush push. Like, he somehow gets the tush. Right. I don't know if that's a Super Bowl play. I don't know if they're going to make that illegal before the Super Bowl. Yeah. But my point is that every seller can do their own style and do it differently to get the job done. And there's room for all of it.
Yeah. Well, and I think I saw a video from, I guess she's controversial now, Cody Sanchez. And she was saying that the hardest thing in business is hiring, because you don't do it that often. It takes a while to get the results. And so to your point, when she said that, like, everything about Cody Sanchez, I agree with that point. Like, hiring is hard because You don't do it that often. It takes a while to get the results. You forgot what you asked, what you promised, like there's a lot. So you go to sell a business, it's once in your lifetime, maybe twice.
Yeah.
And so to your point about even someone who's experienced in doing it, well, how many companies do you see that are exactly this way? Well, not many, because every company's got its own nuance. I think that gets lost for a lot of owners is, well, my buddy sold for this. Like, well, yeah, cool, but your company is different for these 15 reasons. Oh, you're like,
My friend sold for 20 million and he was only making like 4 million more than me, right? So yes, I get that all the time where people give me this wild example of somebody, it's like they had this girlfriend at camp but nobody's ever met her. Like it's this kind of example, and you just have to work with it. And I try and ask questions surrounding it because it's like this story, it's like somebody who met like this, your friend who first day of college, he met this supermodel. And then like 3 weeks later they were engaged and she accepted a half-carat ring and wanted to live happily ever after. Like, it's just like, like it's a complete farce. You don't know. So to mitigate that, I just start to ask questions like, EBITDA doesn't always in their mind equal that, right? So this one seller, he's like, oh yeah, we're doing 3 million in profit. And when I got his numbers, it was 3 million in revenue. Like we just weren't even on the same page. And I thanked him and I think he was very embarrassed. I asked a lot of questions even ahead of that. His wife was in the office. Like he wasn't sure which was, and maybe that's why the business wasn't as profitable because he wasn't sure what was revenue and what was EBITDA. So there's a lot that goes into it and it's very nerve-wracking and it's hard to run a business. Even an easy business is still really hard to run. Just there's so many little things you have to keep chasing. Or, I did a post yesterday on X, that I was mentioning all the things that I'm kind of dealing with right now in some of my closings for this month. And it's just a lot of minutia, everything from lease assignments to there was some trust document and then somebody's getting investors on a searcher deal. And so you got to herd those cats and everybody's got to put in their bank statements and sign accreditation forms and like fill out stuff for the bank. And so you're just like pushing wet noodles and like, or sweeping up. You have 4 kids, so you're sweeping up wet rice. That's like the worst. Like sweeping up wet rice is very difficult. So, these are just some of the things that people have to deal with all the time. And it can get overwhelming for a seller. And then when their business doesn't sell and they spent a year and nothing worked, it's heartbreaking for them. Like they're just exhausted. And I had that too. This year we had a seller and the numbers came back low and we just could never recover those deals. Then the offers kept coming in lower and lower than what they wanted. And, we just can't get them what they want.
so what do you do with, not that particular case, but in general for a seller, like they want, let's say 10 million, offers come in at 6, 7, 8, whatever it might be, and they actually need 10 for whatever reason. 10 million might and this is what gets lost. People, oh, who needs 10 million bucks? Well, after taxes, if you pay your employee bonuses. So let's say they actually need 10. They need 10 to retire, but they can't get more than 7. Like obviously it's emotionally draining, it's disappointing. But what's your advice to people who go through that process and they can't get the money that they expected?
Usually they understand, it's not what they want, but they understand. And, I suggest like, hey, let's just go back to the drawing board. Let's, add some different things. I might recommend a CFO or some strategy so that they can kind of get to the next level. We'll talk to them about it. I don't do, straight consulting and exit work the way you do, but, I'll make a few recommendations and then sometimes they come back and they have done it years later. And I have a deal like that now where they did get it to where they wanted and now we're selling it this year. So, and we started talking, I think in 2021. So they cleaned up the books, they separated corporations, they got everything ready. We'd speak periodically, but they're the ones that did it all. And then we're able to get them the result. But it takes time and patience, and that's not always fun either. And sometimes they come back 6 months later and they're like, okay, I'll take the 7 million.
Yeah.
And I'm dealing with something like that next year, where I kept getting offers at like 7, 8 million, like exactly that. And they wanted 10. You're like talking about an exact deal because they sold another company for 10 million a few years prior. And so they wanted that same minimum, but this one just doesn't make as much. I mean, it's still good. Like it's still making like 1.7, but it's not the same.
It's so hard because I've ran a company since I was 22. Owned a company for, I don't know, since 2019 now. But but for a long time, I worked with kind of the corporate oil and gas execs, not execs, but project managers, project directors, stuff like that. Since I've left that world, it's been a lot of owners. And how, because I ran a company, ran a family-owned business, and so I understand how that works, and I understand all the pain and the anguish and the torment you're talking about. It's like, yeah, and you feel bad for them because they get hate on by so many people, but all these rich owners, and it's like, man, the stress that goes into this, and so I do feel bad for owners because this is a high-stakes game, and I don't. And now this is probably my last question for you though, is that this is a high stakes game, as I said, and it feels like owner education, or M&A education in general, has really started to spike in the past 3-4 years. It seems like something like that. And if you're more of that boomer generation, understanding how to sell your business and stuff was probably a lot harder than it is today. But even today, it feels like a lot of owners are trying to play catch up. And to your point, they're really busy, they're really tired, they're getting burnt out. And it's like, man, this becomes a problem because how do they solve that issue to where they need to understand their value, I would say, to your point earlier about getting a QofE and understand that. They need to have kind of a plan, but how do they get to the point to where they make this decision in the best way possible? Because you touched on earlier, you said they're kind of afraid to spend a few $1,000s. Well, do you know Josh Lowenthal?
Yes.
Okay, so Josh, I love his tax stuff. I call him the Yoda of tax Twitter, but he cracks me up. And but he's riffing on Wyoming LLCs today. The amount of owners who will pay for scam advice is crazy. It's absolutely crazy.
Right.
But all the stuff you're saying here, it's like, just listen to what she's saying, pay to get it done. It's not fun, but it's actually what you need. Why is it that, is it lack of education? It's not a new industry, but it feels new compared to what it was. Why is it that owners they'll pay $50,000 for a fake LLC, Wyoming tax write-off thing, but they won't pay just to get for millions of dollars? It's literally millions of dollars for, not all, but for a lot of companies.
Yeah. There was a QofE that we did this year, and I'm convinced that we got at least $5 million more for the company. And another one, we did get at least $3 million more for the company because we had a sell-side QofE. I would say these QofEs, one was like 15,000 and the other one was 55,000. The bigger one was 55,000. So for that 55,000, you get $5 million. Like, if you don't want to pay the 55,000, I'll pay it and I'll take that spread. Like, that's a great deal. But not everybody wants to take that. Why will they pay 50 grand for the fake LLC in Wyoming? Well, because it's easy. They're just writing a check. When you do a QofE, it is hard work, and you are doing work, you're analyzing, you're pulling reports, you're answering deep questions. You usually have probably 5 hours of calls with an accounting team asking you deep accounting questions. Like, it is not fun. In fact, I might say the proctology test is easier and more fun, right? At least you're not awake. So, it's some serious work. It's no joke. And I think that that's why you see that. People also will pay $50,000 for a fake valuation for a company that pretends to sell your business and they don't, right? And then they give you some ridiculous price that they could never get. They just want your 50 grand. So there's that too. And, I think there's so much coming at sellers, it's hard for them to discern. Now, let's talk a bit real quick about why are the universities doing so much education on buying a company? Like, do you know why? Because I have a theory.
Well, okay. Do you want to hear my full thesis on colleges in general, or are you asking why? I mean, I think it's a money. I mean, so I will tell you my experience, and I would love to hear yours. My experience, in all honesty, is it's easier to find buyers to pay you than it is to find sellers to work with you. And so, from a college standpoint, training them on how to do the ETA stuff, business and the ETA. But that's a market that I see a lot of people tapping into because it's so much easier to get the buyers, because the amount of people who aren't serious buyers that will pay to pretend they're serious buyers, it's crazy.
It's amazing, isn't it?
It's amazing, yes.
It's amazing.
So what's your theory? I want to hear.
Okay, so a couple things. So yes, it's always easier to train buyers to buy a company that they'll never be able to buy. And while I think anybody can own a business, maybe not everybody should. That's a whole other segment. But as far as like the universities, these investment banking jobs, these private equity jobs, they're not everywhere, right? And then the high-end software jobs have gone away, and a lot of the high-end medical sales jobs have gone away, and a lot of these high-end jobs have gone away. They've gone overseas, they've been replaced by AI, they're being replaced by lower level staff, or they're just taking really elite people that's supported by a bunch of lower level staff. So they're changing the model. And so these really high-paying jobs are disappearing. So they have to at least sell this dream of buying a company. And so that's what they're doing. They're selling this dream of buying this company that maybe you should or shouldn't own, and maybe you have the skills or you don't of, owning a business. And it's treacherous. I think some people will make it just like everything else, but they need to sell something because they have to convince you to go to your school, right? And pay you, pay this university thousands and thousands of dollars. And I agree with you on college, just by the statement that of what you said, like, and we homeschool our child as well. So we're in agreement on that as far as like college. I think that you should go for specific skills, but I think as far as general attendance, I don't know that you get as much out of it as you used to. So I'm quite mixed on a lot of the things going forward, but that's why I think universities are really bullish on selling this idea that you can have your own company, because then you will attend their classes and become a millionaire by buying your own business, right? And
Yeah.
that's their theory. But I think I wish they tracked it seriously
Yeah.
of who actually did that, because it'd
Okay.
be maybe 10%
Yeah,
or
10%.
less.
Less, yes, yeah. Okay, so
Yeah.
I'm going to humble brag here. I was going to tell you right now. I didn't go to college. Well, okay, I did. I dropped out, but didn't graduate college. And so what I think about when I hear all these people going to college, and I saw a guy the other day like, I'm going to go get an MBA. I'm like, why? Okay. Despite that, I have met the president of 4 different countries, the head of the African Union. I'm on the board of advisors for a U.S. Presidential Foundation, and countless ambassadors and ministers. And I didn't graduate college, much less have an MBA or anything like that. And I mumble, I'm not the best looking. And I say that to say that it's not that I'm the GOAT, it's that your point about college and these courses, the buyers, that they tap into what they want, this desire. It's like, you just got to learn the skills. Like, and no offense, but the college professors, by and large, probably don't have the skills that you need. And so they can tell you, oh, it's like 1, 2, 3. It's like, no, like, I mean, okay, I'm sure
Right.
I know you have way more stories than me, but I got some stories of owners. It's just like, oh man, how do you deal with these people?
Right.
And my joke about talking redneck to redneck with owners, it's the same thing with foreign dignitaries. Like it just works. Like I've had to learn that. And
Yeah.
so I think that for buyer, if you're listening to this and you want to be a buyer or you're a seller and you're thinking about getting the fake Wyoming LLC set up, you have to listen to marketers and realize that marketers, and you touched on it, they say no pain, no speed. I mean, it's fast and no pain, right? That's what they want. That's what marketers want to sell you, and they know you will
Right.
pay for that. If you listen to them,
Right.
that's what they all say. Oh, sell them speed and no pain. And so $50,000 for a fake LLC, cool. You want to buy a business? Come to these, come to this, MBA program or whatever, or come to my course. And there's some good
Right.
stuff out there. So I'm not saying it's all a zero. I have courses, so I can't say it's all zero. But I also
Yeah.
think that it's like, hey, listen, you got to realize that it's trust, it's a person's ability, and man, it's a bloody world out there. And so how do you, maybe for owners listening, going, okay, yeah, what do I do? How do I do this? I don't want the Proctology exam yet. So what's step one? You mentioned CFOs a few times, and I think fractional CFOs are probably the most underrated spot in the industry.
Agreed. Yeah, I
So
think you
would
could
that
get a
be
cash
step one?
proof. Yeah, step one, you could get a cash proof. You could do that, even maybe from your accountant if they're good. You could get a part-time CFO, a fractional CFO, which is really a part-time CFO, but
Yeah,
fractional is like the
yeah.
more elevated term.
Fractional.
Um,
We're professional or fractional. Yes.
Yeah, yeah. So, but I think that that's a really great way to go. And again, like you're cleaning up your books, you're cleaning up your plays, you're putting systems in place, you're creating handbooks, you're creating processes, you're finding ways to delegate some of the low level tasks that you shouldn't be doing and you shouldn't be doing,
Yeah.
just different things. Like, and I get it. Like, I had I had this seller and he liked to, do some of the cement work sometimes. Like he just liked it. And I said, okay, so like 2 days a week you do cement, but the rest of it, like you're out of there. Right. And
Right.
so that at least kind of gave him a path. Or, the guy who I told you he was 81 and I sold his company, he outfitted trucks with aftermarket parts, not like Pimp My Ride, but for construction vehicles to like flashing
Yeah.
lights and
Yeah.
like
Yeah.
all,
Yeah. Yeah.
toolbox, all the necessary things. And, I met him when he was 79. He's like, Jackie, I'm not ready to sell. I'm like, well, okay, then
Yeah.
don't sell. He's like, well, everybody says I should sell. I'm like, that's their problem. Right.
Yeah.
Like do
Yeah.
things for you. I said, call me when you're ready. And he was ready the
Yeah.
next year. And so we sold it. I think, if you have the property, do a property inspection. If you're going to lease it, start paying yourself market rent. If you're leasing it and you don't have enough time, you don't have at least 10 years, then go and get those additional options and like get everything in place. If you are the owner of the building, figure out what you'd want from them. Would you be charging CAM? How would you be, some states charge sales tax, some don't, all of these different things, but you've got to like sort out these decisions ahead of time. I'm trying to think of some of the other things I was thinking about doing, like, list of your digital assets and all of the passwords, and like making an actual transition manual for somebody so that they have all of the stuff, digitally, but then you have a physical printed out manual, like, here you go, this is the business and I made this for you, because that makes it easier on you. So doing all of these preparations ahead of time will help reduce stress for the seller. And I think that these are just, and it'll make the transition better for the buyer and a better relationship, because then they're not chasing down the Wi-Fi password like
Yeah. Okay. All right. So I went on a
ex-husband in the
crazy.
house.
So I went on a crazy humble brag rant. You close us out with your humble brag, because you've been doing this a lot longer than me, and I'm not trying to age you. I'm just saying like this factually. So let's hear your humble brag, and we'll close. And where can people find you at?
Yeah, well, Ryan, first I have to say I'm happy I lived this long, so I don't mind. And it's an honor to be here and like speaking with some of the people that you advise. As far as like, I've owned companies, I've bought companies, I've sold companies, and I've closed a company. So, I've felt some pain. And I think for business owners, my heart goes out to them. It's a hard go. And when you're ready to sell, like the more you can prepare, the better you are and the better you'll be. People can find me on the Deal On Me platform. They can find me at Crown Atlantic. They can find me at SMB Jackie Hirsch on X, and LinkedIn is Jackie Ossin Hirsch. Because why make them all match? That would be too simple. So I'm around, and I'm sure you can like search my name and find everything. But I'm happy to answer questions when I can. Sometimes we get like 30 to 50 buyers a week that want to just chat and introduce themselves, which is a little too much. And so I just can't always have time for everybody.
Yep.
Except for what's on my deals, but I'm always happy to try and at least guide somebody when I can, and happy to speak with sellers about how they can prepare their business ahead of time, at least get my opinion, and we don't charge for an upfront valuation to, see if you're kind of ready. And so there's ways to at least kind of gauge, and, it'd be a pleasure to, speak with some of those people.
Well, thank you so much for your time today. And your humble brag was way better than mine. So mine was low. Like, I've met some presidents and some ambassadors. You're like, I actually made money. It's a big difference. I like that. I like that. So it was great to finally meet you, not in person, but virtual person, and talk. And
Yes.
Thanks to Deal On Me, because they are sponsoring the Exit Ready cohort, which is starting on January 13th. So thank you guys for doing that.
Yeah.
And look
That's
forward
awesome.
to, hopefully, if we do another one that you can teach one week, we'd be so honored to have a legend like yourself on
Thank you.
one of those weeks.
Well,
So.
Clint's a visionary. And we're pleased to support him. My brother and I are both LPs in Dealonomy, and it's a really like forward-thinking platform as far as how to transition your company, and it's very exciting. So I think people should definitely check it out, and it's great that he's sponsoring. So hopefully I can work with you guys in the future. Be wonderful.